Good morning. Welcome to Bazaar Morning Call. We are live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. We kickstart a brand new week. I'm Sonia and with me are Nigel and Surabhi. Thanks a lot for joining in. Folks, good morning. Nigel is back from his holiday. Welcome back.
Well, good to be back, Sonia, but I had a great trip. I went to Dubai and spent a lot of time with the kids. And it was great. Today I'm just trying to recollect all the passwords and get back to the markets.
But the markets missed you, and I hope that you're a lucky charm. You come back. And
Credit Suisse is sorted out. I'll try to see what else we can do.
Good job. You're like setting the world in order as you're coming back. But it's quite a morning. I think it's been a sleepless night for a lot of us yesterday because the action went on way into the morning hours, and it's a bit like deja vu. Global coordinated central bank action. It's just bringing back memories all over again.
I think, after what years of falling stock prices and trouble, issues with Credit Suisse, finally the Swiss regulator has decided that, Credit Suisse cannot stay as a, standalone bank. And here comes the bailout. UBS, that's the big headline. UBS has bought Credit Suisse for $3.2 billion to stem the banking crisis. And not just that, the Swiss regulators, in fact, have put in about $108 billion as liquidity assistance. Now, that, of course, is the headline. But, with this bailout, do the problems end? No, they do not. And that's what you're seeing across the global markets as well. The Dow futures are in the green, up about 100-odd points. But the SGX Nifty is indicating a big fall this morning. And I'll tell you why. It's not just what's happening with Credit Suisse, right? It's across the globe. The US markets had a big fall on Friday as well. And this is after what's been happening with the US banks. So there is a systemic risk concern over there. The latest is First Republic Bank shares. In fact, First Republic Bank shares were down 80% now in just 10 days. And it was a 33% fall that we saw, despite a $30 billion support that came in for the bank. So there are lingering concerns. And now the US FOMC meet that happens in a couple of days from now, it will not only be about a rate hike or not. It will also be about what the Fed plans to do in terms of stemming the banking crisis that's currently underway in the US market. So that's the big headline. For our own markets as well, it's been 7 straight days of FII selling, and now over 9,000 crores has been pulled out in 7 straight days. And the Nifty has, of course, Friday was not a bad session. We pulled back from the lows. But in the last 1 month, if you map it, it's been 4.5% of a loss for the Nifty. The next level to watch on the downside is the September low of 16,800 thereabouts. Now, it is definitely a firm line in the sand, and because of the rescue package that has come in for Credit Suisse, perhaps you could see a little bit of a pullback today. But the texture of this market has definitely been on the weaker side. So that rally, whatever comes through, could get sold into. At least that's what's historically been the case. Now, the US FOMC meet is the next big thing. So expectations of a 25 basis points rate hike over there. I also want to watch out for what happens with crude, because crude is now at a 15-month low. It slipped below $74 a barrel. So once again, demand concerns, etc. So it's going to be an action-packed week. Yeah. And I was just looking at the calendar. I thought maybe this was the week that we have a holiday, but no, it's next week.
No, the central banks will ensure that you can't take it easy just yet.
I was, full week, yeah.
Absolutely. I was just going through all this news flow over the weekend, and then I kind of put it together in 3 questions, sorting it out in my own head. And I think these are the 3 questions the markets need an answer to as they get through this rather long next 5 days. So let's just pull up the 3 questions. I mean, number 1 is a very basic one, that will this buyout of Credit Suisse by UBS, will it stem the rout? Can markets go back to their normal ways? That's question number 1. Question number 2 is the bigger issue. Are there more SVBs in the US? By the way, Signature Bank has found a buyer. There's so many headlines coming in thick and fast, it's tough to keep pace. I didn't put up that point. But Signature has found a buyer in that, oddly sort of auction that was taking place. New York Community Bank Corp is buying Signature. But the question is, what else is happening in US banking? And the third and the most important one is, what will the Fed do? Will it go in for inflation fighting, or will it go in for market stability? And we'll have that answer on the 22nd. Just to quickly roll over some of the details of this UBS buyout. We all know the valuations. I mean, it's about a little over $3 billion. The closing price of Credit Suisse as of Friday was around $9 billion, and that's the gap. The biggest important good point here is that the Swiss National Bank has come in with that backstop, about $100 billion in terms of liquidity promise, and more importantly, $9 billion guarantee on those losses. There are some caveats. That this guarantee kicks in above a certain threshold when the losses cross that threshold, and it's for a specified portfolio. of assets that UBS takes over from Credit Suisse. But the markets will have to take heart from the fact that at least there's a guarantee, at least there is a backstop by the regulator itself. The third question, I think that's rattling the markets with respect to Credit Suisse, is this write-down of AT1 bonds. We've seen this tape play out here in India with Yes Bank, remember, a couple of years back. And that's what happens. AT1 bonds are as good as equity, and equity gets written down. And therefore, there's a big loss figure that the markets have to contend with, the bondholders have to contend with, and that's about $17 billion. And we'll see how that's digested in markets over the next couple of hours. The other good facet of this is that all the central banks came together. We had a statement from the U.S. Treasury plus the U.S. Fed, a combined statement from Janet Yellen and Mr. Powell. And that's what the statement said. The capital and liquidity position of U.S. banking system are strong and the U.S. financial system is resilient. We have been in close contact with our international counterparts to support the implementation. Not just this was, of course, the statement. What have central banks done? The big guys have come together, Bank of Japan, ECB, the Bank of Canada, the US Federal Reserve, all of them have come together and they've opened up the floodgates, the swap lines, the dollar swap lines. Till now, the swap lines were weekly. Now they are daily. The last time this happened was actually when the crisis, the pandemic was starting, and even before that it was 2008, which is why the goosebumps really come back to you when central banks get together and take coordinated action. But Nigel, I guess, that also tells you that the extent of this crisis had reached that point where it had to be all hands on deck. We've seen signs of that over the weekend. Now, I don't know, while you were away, we've been discussing this line in the sand of 16,800 repeatedly. Till now, the market managed to hold above. The bulls will, I guess, hope that you kind of take off from there. But I think till we have answers from the global screens, maybe it'll be just tough to get to that convincingly here in India.
Well, that's right. I think both of you all have stressed enough on, what the banking system is looking like globally. So the big question is, has there been a near-term bottom that's been made at around that 16,850, around 16,950, from where we bounced on the last two trading sessions? I'll just look at the intraday lows out there. And is there more steam to this pullback rally that we saw? We have bounced 250 points from the recent lows. That's two sessions ago or so. The Nifty bank, that was, that saw a good bounce. It's bounced close to 800 to 900 points from the lows that we saw two sessions back. It's ended near the 200 DMA. The bulls will want it to move closer to around the 20 DMA. And if that happens, then it gives the bulls that hope that maybe the Nifty pulls back to around that 20 and 200 DMA on the Nifty, which is at around 17,450 odd. Let's focus on what the FIs did. Yes, you had a relief rally, but it wasn't short covering that played out, at least on the FI side, because they added shorts. And now the net short positioning, that's the short positioning minus the long positions, well, it's at 1.7 lakh odd. I'll tell you what, this is the highest that I've seen in the last many, many years. And in terms of positioning, 90% of their positions are on the short side. So they continue to add shorts on index futures. What's giving you some hope is the index options data. They bought more calls than puts, close to around 4 calls for every 1 put. But what's giving you more hope is that, in fact, the put writing was back. And they wrote close to around 3 puts for every 1 call that they wrote, telling you that maybe in the near term, a bit of a base has been formed. On the upside, remember, we're not going to see a big runaway rally, but the hope is that maybe the near-term base is formed. What are the puts that they wrote? 17,100, 17,000 put. Between them, close to 45 lakh shares were added. So that's tell you that maybe at lower levels you could see some buying. Well, 17,300 will be a bit of a resistance zone. So let's get the levels up for you. Recent lows, we have the resistance zone going by the 17,200 level. But the Nifty bank, that's the vital one in there. It ended close to around the 200 DMA, just 30 points shy of that. You'll want it to head towards the 20 DMA to give you some hope. Since the SGX Nifty is suggesting a 90-point downtick, maybe today at some point of time, risk-reward could favor the bulls just in the near term, because you start around that 17,000, little below that level. 16,850 becomes important on the downside to hold out. If that holds out, maybe we'll see a bit of a relief rally.
Okay, 90% so let's see that
FI short positions. Yeah. That's a remarkable statistic.
Even in quantity, 1.7 lakh is, the highest. I think in the pandemic, briefly we went to around 90% of short positioning. So they're aggressively net short. The hope is there is some bit of positive news that comes out. And if that comes out, when you have such an aggressively net short FI sitting out there, it could provide the glimmer of hope. Not out of the woods, but a short covering bounce cannot be ruled out.
Absolutely. Okay, but let's see. Important to see what happens with the banking stocks globally as well. There is a turmoil underway both in the US and in the European banking system. So does that lead to some sort of snowball effect and more pressure in the banking space? Time will tell. But for now, the SGX Nifty is definitely indicating that we are headed for a bit of a volatile start, a start in the red, and then we'll take it from there, down almost 100 odd points. But we have a lot of commentary coming in for you to tell you how to wade through the day and the week. First up, Jonathan Garner of Morgan Stanley says that rapid liquidity injections and falling peak rates have capped the US dollar and lowered nominal real rates. He says their financial analysts see limited impact from developed markets' financial issues, but weaker emerging markets may see spreads widen. He says relative Asia ex-Japan EM's appeal improves along with China growth and the healing global semiconductor cycle.
Let's get you some money market views now, and this is coming in from B. Prasanna of ICICI Bank, who says uncertainty around banking crisis in the US and Europe kept EM currencies under pressure. He says the rupee is supported by expectations of increasing interest rate differential, improved trade balance, lower crude prices, and seasonality. However, he adds that the deterioration in risk sentiment is a tailwind for the rupee in the near term. He expects the USD-INR pair to be range-bound and trade in a band of 82.20 to 83.20 this week, as the RBI is expected to smoothen volatile movement on either side.
And on the bonds, B. Prasanna says that bonds continue to rally globally amidst a sharp correction in the terminal rate expectations and discounting of faster cuts as stress in the banking system remain prominent. Back home, he says year-end investors' demand added fuel to the positive sentiment. He expects the bullish momentum to continue with the 10-year benchmark bond deal expected to trade in a range of 7.25 to 7.40%.
Well, we've given you trade setup as well as the global setup. So let's run you through all the stock-specific action that we'll be tracking for you in just a bit in our special Top 10 segment. We'll look at HDFC Bank, HDFC, Tata Consumer, Canfin Homes, GMR Airports, Godavari Power and Ispat, Kochi Shipyard, as well as CMAT. They are stocks on the back of positive news flow, while on the flip side, Adani Enterprises and Biocon could react to negative news flow.
Okay, but of course the overarching theme will be the